Ladies and gentlemen, welcome to the Capital Flows live stream. Just pull this up. All right. We are back, baby. Monday morning, a lot of really exciting stuff happening over the weekend with how the entire PURR situation is developing. I just published a report explaining that this situation has changed in a way that I didn't originally anticipate that it would. And when, new information comes to light, when you see a change in positioning, it is critical that you adjust your thesis accordingly. And what we have seen over the last 5 trading days, and specifically the last 2 trading days for what happened on Friday of last week, there is an escalation that I didn't even expect to happen to the extreme that it is taking place right now. I knew that there was asymmetry. I knew that we were stacking edges, but with how there has been some complacency in positioning, there is a very high probability that we are going to see a gamma squeeze in PURR that is going to push the price significantly higher and likely cause it to trade at a significant multiple to the underlying tokens. And so, what I wanted to do and what James and I have been talking about over the weekend is we want to pull together all these moving parts for you. James and myself, we're traders in financial markets. Our entire goal is to manage risk and get paid to hold risk. There's really no benefit for us to have, high in the sky kind of views about what could happen if it's not backed by an informational edge that we can monetize. So at the end of the day, the most important thing that you can do is align your own information flow with people who are actively taking risk, who have skin in the game. And if you've been following me, you know that I've been long PURR for, since we were sub 3, we hit $13 on the Hyperliquid platform last night in the PURR DAT contract. And so we have had a massive run. And one of the things that I'm going to have James break down is a little bit on this idea where why is it that, when you see something go into the money, it's so hard to hold winners or add to winners? What is it in who we are that wants to self-sabotage our own success instead of saying, what's the thesis that is laid out? Why are things taking place? How can we adapt to them in real time and not have all of this kind of baggage that limits the true potential that we have? And then I think in many times, we're afraid to really see ourselves accomplish. So if you're here, we're going to cover 2 things. One, the technical side of everything. You get to ask any questions that you want. We'll be covering every single one of them. I really want to take time to go through everything. And then number 2, which is equally important, and I say that because the majority of people here are going to not think that it's equally important, but it is how do you mentally process through all of these changes that are taking place and think clearly about it. So with that, we will get started. James, how are things going? How is the Monday morning treating you?
It's pretty violent out there, honestly. It's super exciting. After you're in markets for like a really long time, you hate boring markets, like you just like, it really is interesting when you come in and you see like Dell up 8% and like other random companies down 15, right? That have all been moving. Like nothing's been in lockstep. I know we've talked a little bit about this idea of a rising tide, like everything rally. And it seems like we're on the cusp of that, but it's interesting seeing each day you come in and like one sector is getting whacked, the other one's getting all the goods. Like it makes it super exciting. I won't get into being in the Bitcoin sector. That's not as exciting, but it is cool. I'm having a good time. Markets are like super fun. And if this is at all about like, a preview of what's to come over the next few years, I mean, it's going to be a good time.
Yeah, I think the other thing that we'll touch on today is the entire connection to Bitcoin, why Hyperliquid is up when Bitcoin is down. I think answering that question is fundamental to the thesis that we have right now. And, I remember when I was laying out the thesis that's primarily based on HIP-3, which was the entire value proposition of Hyperliquid, or one of the main tenets for the proposition. Everyone said, like, no, you don't get it. If Bitcoin goes down, it pulls everything with it. And, this is just such a clear example of, understanding how the underlying factors change in real time. Because if the cash flows for Hyperliquid shift their source from Bitcoin to traditional markets, then you should expect the cash flows of Hyperliquid to correlate more with traditional markets, which is exactly what we have been seeing. And it's hard for people to recognize the potential of what could be. It was unseen at the moment. The probability of it was increasing, but there was no immediate technical line you could draw to begin to ride the short-term momentum. And that is the problem in markets, I think, today, is that everyone has become a short-term momentum trader. And don't get me wrong, I always overlay short-term momentum in a thesis that I have. But I think the key is that everyone is looking for the confirmation. And, if you're always waiting for the confirmation, you're going to be at a disadvantage when that confirmation eventually hits. And so you have to have wider stops. You have to have these other changes, right? For the PURR thesis, when I was laying that out at, sub 350, everyone thought, like, well, let me just wait for it to trade a little bit. Let's wait for confirmation. Let's wait for this or that. And at the end of the day, you get paid to take that risk. There's a reason you get paid, and it's more of a risk management thing and a positioning sizing dynamic than, well, I just want to see the chart develop so I can draw some technical lines, right? And I think that's just, it's critical to think about that for what we're moving into right now, because this entire idea of the parallel I'm drawing to GameStop is currently unseen. We have yet to see Hyperliquid or Hyperliquid strategies PURR rally in a comparable manner to GameStop. And the key thing to note is that it is possible that it doesn't happen. However, if you look at the underlying flows and the potential that exists, the signals are there, but we have yet to realize it. We have yet to actually see a true gamma squeeze. But it's just this basic thing where if it does happen, it's a really, really massive payout. If it doesn't, the baseline is the thesis continues as I've been laid out. And so what I'm going to do is break down where we have been so far and how it connects. So again, if you are not a subscriber yet, go to capitalflowsresearch.com. I laid out the entire thesis for the gamma squeeze May 30th. So that was day before yesterday on Saturday. And I talked about the big picture context, about where we are in the credit cycle, how I've been laying out PURR, how we're up significantly year to date, all the credit cycle research. One of the key things is we are in a period of time very similar to 2021 right now. That is abundantly evident in the data. People that are saying that liquidity is contracting, they're just not looking at the actual market. They're not looking at the underlying data, because every single thing is saying the opposite. So what I would encourage you to do, if you want to set yourself up for success to understand the thesis, you should go through this entire article and read everything. I laid out everything here. And, don't expect to have really good execution and an understanding of the thesis if you're not going to put in the work just to read a basic article. All of this is free. This entire article is free. And so the idea here is that all of the research that I lay out is going to be on the website. I have paid research that is proprietary for paid subscribers that I'll cover in a little bit. But the idea is we are in a point in the credit cycle that is forcing capital out the risk curve. So if you just go out and look, and James can actually probably walk us through a couple of the different changes that we're seeing taking place, we are seeing so much capital move out the risk curve that it is causing a lot of different small cap stocks and high short interest stocks to rally. That's one of the ideas that I laid out in the article where I said, if you just look at the Goldman Sachs non-profitable tech index or the most rolling short index, which just says, what are all the stocks that are the lowest quality? What are the kind of names that are most short, that hedge funds are most short? What is happening to those? And we are seeing 2021 flows in functionally the same manner that we are seeing right now. And that frames the context for everything. It would have been unlikely for GameStop to have the squeeze that it did if we didn't have the credit cycle melt up that we had in 2021. Just wouldn't have happened, probably. Maybe you would have had some type of squeeze and shorts get squeezed out and you have a little pop or something like that. But fundamentally, when you have a lot of money in the system, it starts moving out the risk curve. And then you also squeeze shorts. And, James, you can kind of talk to this a little bit on all of the other kind of stocks that you're seeing right now really make some of these massive moves because of the amount of money that we have in the system.
Oh yeah. I mean, if you guys ever go to I spent a little bit of time this weekend on Claude going through like the AI kind of, if you want to call it the 5-layer cake, right? The token flow, right? I think I said to you what I was kind of doing on the token flow stuff. And it's like, you have the money that is coming into AI and how does it flow down through the entire stack of technology all the way back down to like commodities like rare earths and copper. And I was looking up all of these names thinking to myself, oh, I'll probably find a little diamond in the rough here. No, everything is up like 500%. Every single thing. The people who had kind of like went full bore into this, the smart money that accumulated over the last couple of years are all absolutely crushing. And then that money is just flowing into all sorts of other things. Like where are the niches and ecosystems that will benefit the most from AI, pharmaceuticals, like all these things. And it's really fascinating to see. But then you have to toss into that the geopolitics at play, the catalysts, the Trump call outs. Like it's such a dynamic game right now. And if you're playing it poorly, you could actually be getting absolutely whacked, right? So it's super important to be like thinking about not only like the regime that we're in that we talk about here every day, but like where's the sentiment flowing to, where's the positioning getting out of control or not being at. And you got to start playing that cat and mouse game and be like skating to where the puck is going. And it's not to say it's hard or not to say it's easy. It is difficult, but that's what makes this game great. And just before you move on, I wanted to point out that like the point you were making about nobody believing that your position like PURR made a lot of sense. How could Hyperliquid actually outperform Bitcoin? Blah, blah, blah. We've talked a lot about the best investors in the world who have made the biggest, greatest asymmetric plays. None of their positions felt comfortable when they made them. They had to go through this period of time where they were questioning everything. Nobody was really on their side of the boat. And they had to really deep down find a conviction and a belief that they were seeing something that other people weren't. And because of that, that's when they had like the asymmetry and the risk that you're holding starts to pay off is when it's starting to be proven that you're right. And I think that's what we're seeing now. And now, of course, we're starting to discuss the other potential outcomes down the road. And it doesn't mean that they have to happen, but if the tails start to grow, right? If this right tail event starts to grow, you need to start opening up your mind and breaking through that ceiling that you might have had to say, wait a second, well, am I just creating a story for fun? Or is there actually a change in the story here that might grow that right tail significantly? And if so, how should I adjust my execution moving forward? So really cool stuff.
I agree, and I would encourage every single person on this live stream. If you are kind of blindly coming in and you're like, oh no, what do I do? I need to maybe just like do something or else I'm gonna miss out. You need to stop right now and probably just get off this live stream or just take a step back from markets and just observe and learn. Right? Like you should not just be chasing in to anything. Nothing we're doing is providing investment advice or anything along that lines. Right? Like we're just sharing what we're doing. and educating people about the mechanics of the system, right? And so I'll always talk to people. I've had friends hit me up about some of the thesis that I've laid out, and I'll just say like, hey man, like you have a better bet in life right now in your business. This is probably the thing you shouldn't be. It's probably not the thing you should be focusing on right now. And I'm telling them not to do something because they have something more important in front of them, or they don't have the reps that an experienced trader would have to monetize the returns or in turn understand the thesis. Or maybe they do. I know traders that do, but they just don't have the time to understand the thesis. And so that's why, one, we're doing these live streams so you understand the thesis, you have the time to. But two, I would just encourage you, you need to build a foundation of knowledge over time for how these mechanisms work and not chase into anything. If you're operating out of fear, just expect to lose no matter what the outcome is. That's what you should definitely expect. And so when we're thinking about the environment that we're in, the credit cycle, and again, this entire slide deck, it'll be laid out afterward at capitalflowsresearch.com. I'll link everything. If you're a subscriber, you get all the slide decks and everything like that. So, just go to the website and go through everything there, okay? The idea here is that the credit cycle is injecting a ton of money into the system. When that happens, rising liquidity pushes capital out the risk curve. And it goes from investment grade to high yield to equities to the speculative, asymmetric things that we are seeing taking place. And real rates are one of the key factors into that. The other key thing is the carry trade and some other factors that I've covered in the reports. So again, if you are trying to understand macro liquidity, you should just go back to the reports that I did on the credit cycle melt-up. We are way too low in interest rates for them to be restrictive. Interest rates are not restrictive right now, to be clear. They are not being restrictive to the underlying economy or to financial markets. And we are seeing a retooling of the economy that is actually shifting how the liquidity transmission mechanism even functions. If people are talking about liquidity and they don't know how AI is retooling some of the liquidity mechanisms in the system, they're really missing how much liquidity and money is in the underlying system itself. So we are seeing capital move out the risk curve. This is a fundamental idea that you need to have for any bet, because if capital is not moving out the risk curve, then you should not be as aggressive. It's very simple. If capital is moving out the risk curve, it is an environment where you want to be aggressive, where, there is, I've been laying out the credit cycle for months now and how it's pushing capital out and it's going to cause stocks to rally significantly, which we have seen. And I've said that this is, a lot of people don't want to buy stocks because they're saying, oh, well, it's already at a high. If you think stocks are going to go higher, then you need to shift and say, how am I positioning things? Maybe if I do feel a little nervous, I should just size smaller and buy some calls, right? That's a position sizing thing, right? And that's a great example of if you see the market go up every single day in any market and say, oh, it's gone up too much, now I don't want to get long. I never think like that. I think, do I think it's going to keep going up? Do I have risk, reward, and asymmetry? Great, then I'll buy it. I don't care if it's at a high or not. And so when you look at real interest rates and credit spreads, real interest rates have been collapsing for years now. And they have accelerated more recently with the inflation we have in the system because the central bank is pausing into the energy inflation that is taking place. And my view is that we're going to have some type of collapse in crude prices sometime soon. And that is going to allow the inflation in the system. It's still going to be there, but some of the risk premium markets is going to fall. Simply put, once crude falls a bit, we're going to have equities have another pump. And you'll notice right here, real rates are still kind of below their levels. They've ticked up a little bit, which is why we've seen some dispersion in the equity sector. But the fact that they're this low and close to negative for 1 year real interest rates is in itself an indication of the environment that we're in and how much money is in the system, not only in the financial system, but the underlying economy as well. Credit spreads are back down at lows and remain suppressed, which is allowing companies to take out money and debt at a very low cost basis, at a very low price. And so when this happens, risk-seeking capital concentrates into the winner take all disruptors. This is key because everyone is using the past crypto cycle or altcoin cycle or whatever. I don't believe in altcoins, right? I don't believe in any type of like arbitrary categorization of, well, do you think alts are going to rally? I don't know. I don't care about that. That doesn't make any sense to me. It's reductionistic. What you need to ask is, what are the disruptors of this cycle? Because right now, crypto and TradFi are funneling capital into the disruptor. It's the reason why Hyperliquid is rallying and other coins or things like that are not. It's why Hyperliquid is rallying more than a lot of the financial stocks in the market right now. So now what we are seeing is a convergence where Hyperliquid sits at the nexus of all of the largest disruption that is taking place in the US financial system. And that is why so much capital is getting attracted to it. And you want to always filter by disruption, not, oh, well, in the past cycle, this stock, this coin, whatever, rallied this amount, so it's probably going to rally the same amount. Right? It's such first order thinking. You need to shift and say, what are the disruptors? Because all of the best traders in the world are looking for what? The most change and disruption that is taking place. And that's a key baseline to understand where the liquidity is eventually flowing.
One quick question for you on the idea that there's this massive gap between the normal kind of maybe savvy retail participant thinking, since rates are high and we're not cutting and long end interest rates are going up and inflation expectations, there's this idea that like we're just contracting liquidity and we're going to have a really big problem here. Why is that gap so large? And then what are the things that should it be real interest rates and high yield credit and stuff? What are the things they should pay attention to the most that will bring them back to the reality that we're actually expanding and money is moving out the risk curve? Because like the scoreboard is showing that, but people are not closing the gap between what they think is happening and what's actually happening.
Yeah, I think there's two things there. Number one, you need to properly have an attribution analysis of how everything is functioning in market. So, for example, how much are the rises in interest rates impacting US equities? Right? So that's kind of the first question I would ask, which is, a lot of the things that I lay out for paid subscribers is, what are the exact attribution you need to be watching right now? And fundamentally, when you look at how much impact are interest rates, especially long end interest rates and long end real interest rates, having an impact on one, the underlying economy, and two, financial markets, the answer is it's incredibly low. When you look at the deal flow coming out of the corporate credit market right now and the deals that are getting floated across the tape, all of these guys, they don't care about that stuff. All they care about is the demand side for all of these new AI buildouts and all of the changes that are taking place there. Because whether interest rates move up a little or a lot, the bigger factor is, what is the demand side on the AI buildout that is taking place? And that's pushing credit into the markets, which is retooling the economy, and it's creating more spending in the Russell companies. It's reverberating across the entire system. Now, the important thing to recognize is that when I think about the entire AI build out side, everyone is thinking about that relative to, okay, well, we're going to have a parabolic rally. We have higher valuations. So now we need to have a bubble and we're going to pop. The better parallel is to think about it relative to a commodity market with supply and demand imbalances and vol blowing out. Because right now we are seeing a massive supply and demand imbalance, and all of the AI Mag 7 names are functioning more like, basically like almost like oil producers that are coming in and trying to lock in their prices and run and hedge their risk a little bit and be able to provide supply to these underlying demand components in the economy. And a lot of the economy, I think, is just, eating itself, right? Which is why you see disruption. Same thing with the market. But what I would say is that we are not seeing rates have a restrictive enough impact on that part of the market. And we are not seeing it have a restrictive enough impact on any element of the market, which is why this goes back to this chart on the Goldman Sachs non-profitable tech index and the most rolling short index. So I would just say that the models that I'm running are showing that rates are not having an impact yet. Capital needs to move out the risk curve more. And the AI side, actually, we have to go over this because this is something I laid out so many times for paid subscribers, and people didn't really want to listen to me, but paid subscribers did. I know a bunch of people have made so much money. One of the things that I said is that why are equities going to rally? And I said the main reason is because you have so much asymmetry where the semis are probably not going to fall. Like, it's just not going to happen right now. Maybe you have a positioning flush here or there, but there's too much of an imbalance for it to fall. And when we were at these lows, the main idea that I was laying out is that you don't want to be short the index because half of the entire technology sector is what? Software, which is the IGV ETF. So even if you have SMH, quote unquote, overvalued, which is not, but overvalued, and it doesn't rally as much, which it has been, as long as the IGV ETF and software rally from their lows, which I've been laying out that it will, which is why I'm long Oracle, which is why I've kind of been laying out that I think that software is making a bottom. Again, just go back through all the paid research on the Substack. Then it's going to be one of the most supportive things for markets. And on top of all of that, we have the credit cycle melt up that's taking place as well. So all of these factors for the macro backdrop for credit and liquidity, the positioning backdrop for sector flows with tech, which is over 35% weighting of the index and even larger in terms of vol and some other attribution positioning components, SMH and IGV are both rallying incredibly with a lot of momentum, and positioning was offsides, which is why I've been bullish equities and long. And then stack on top of all of that the fact that we are seeing a lot of vol premiums that still need to unwind. There was so much implied vol in IGV that needed to unwind. So when you pull all of those factors together, you can begin to say, okay, I realize now that there is extreme asymmetry in markets that has been abundantly clear. And sure, you've had some rotations here and there with things like the Russell, and you've had the Russell pull back marginally a couple times, but broadly speaking, the Russell is one of the greatest beneficiaries of all this AI capex build out. And so the view that I've been laying out just for months now, and I guess it's just been every single day that I'm on the Substack and explaining things. If you're going through any of that research, you understand all of this, right? You've had all of this context. Then you'll realize that when we talk about disruption and change, then you begin to say, okay, well, we have all these changes taking place. You're having these IPOs now come into the market, which again, SpaceX and also the other previous IPOs that we had trade on Hyperliquid already. Every single person in the financial industry has Hyperliquid pulled up, and they care the most about Hyperliquid and how it functions in the financial system as we're moving into this period of time where if you're not aggressively running risk, you will lose your job. If you're underperforming right now in the age of AI, you will lose your job. Like it is a guarantee. And so people are trying to find every single edge that they have. And now you have perpetuals come on the stage and they say, hey, this is the best way to get access to leverage. And that's why we are seeing Hyperliquid diverge and rally.
Okay, so this is fascinating, and I want you to tell me if I'm thinking about this wrong. So, in a weird way, given that compute and the AI technological shift is effectively like you could treat it as a commodity like thought. But since there is no mature, deep expression of that commodity, the expression lies in actually the stock market itself and the individual equities to express the supply demand imbalance that is occurring right now. But if that's the case, when the supply demand imbalance shifts back towards, like most commodities, when there's a shock, adaptation, more supply comes online, blah, 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 that could actually be leading towards what we've talked about on the back end, where all of that is going to have to get sucked out of the same place that money actually went in. And that's probably why, like, Fink and all these guys want a compute market to come online, right? To be able to kind of maybe express this a little bit better or hedge for these big companies. Am I thinking about that in the right way?
Yeah, I think that all of the supply and demand imbalances that are being created right now and all of the credit we're attaching to it and how aggressive we're pricing everything, and I think we're going to even price it more aggressively, is all setting the stage for a correction that will eventually come when liquidity shifts. And it's my strong belief that the type of credit and liquidity injections we're seeing right now are fundamentally unsustainable once supply and demand just shift a little bit. And at the end of the day, deflation always occurs when there is we basically, demand doesn't come online, or you just have so much supply, right? And what is deflation going to occur? Is it going to be inflation? Is it going to be stagflation? Whatever you want to call it. The entire idea is that we are creating a capital structure that is so fragile, that is leveraged so much, that we are having a basically one-way bet for everything in life right now attached to these AI changes. And it is also impacting the entire economy and retooling the entire economy. So to your point, I think that all of this is going amazing on the upside. And all of the signals I'm running, and again, my positioning is bullish, and I'm holding all of that. So, that goes back to, market timing and looking at the signals and things like that, and not being a bear for bears for the sake of just being a bear. But yeah, I think that there's a lot of risks systemically building under the surface that will catch a lot of people offsides.
Yeah, that makes sense. Because if it's being expressed in that fashion and it's all being directed towards the companies involved with this quote unquote commodity, and you have capital moving out the risk curve with real interest rates going down, policy not restrictive enough, inflation getting priced into the system, but not too much that it craters everything. Like, that's all aligned for a positive impulse. But
Yes.
if all of that starts to reverse on the same sense, like more supply comes online, less demand, maybe there's some bottlenecks where they have to adjust things on the big frontier model side or whatever, then you have real interest rates bottom, then you have policy, say, too tight for too long. All of that tends to that could all align on the other side of this, right?
Absolutely.
Then you have the position, and because people are thinking about it from like a PDE multiple whatever thing, they're not thinking about it almost like in a commoditized fashion, that it's going to then catch everybody off guard in that sense, right?
Yep.
So, but like you're saying, that's future, that's scenario planning or whatever. Right now, we're seeing just the opposite of that, where everything is aligned to the upside.
Yeah, I think it's key to understand the drivers on the upside so you can know when they're going to be unsustainable for the downside. And I think right now,
thanks.
what we're seeing is the upside is getting so aggressive that we are seeing the high probability of a gamma squeeze. Gamma squeeze is simply when implied vol rises with the price. Dealers are basically short gamma, and in a low float name, every hedge they're forced to make pushes the price higher, forcing the next hedge. So basically, if that sounds complicated, I'm sure there's some option nerd out there that's just going to be like, well, technically, yeah, sure, man. The idea here is that when someone buys a call, there is another person on the other side of the trade that is selling them that call. And the majority of those people are market makers. And so they need to go in and hedge their risk by buying the underlying stock. As you have it move closer and closer to the strike, the market maker typically, broadly, has to buy more stock to hedge their risk until they fully realize that option strike and we're basically like in the money. And so the idea here about a gamma squeeze is that you can have a reflexive feedback loop when you have the price going up with implied vol going up. Now, this is one of the things that people didn't really understand about GME is that where their shorts getting squeezed out, yes, but that was only for the first leg. The big leg was when everyone bought calls and dealers had to hedge their risk by buying the underlying stock. The driver for that was when you had more options listed on the underlying. And so right now, we only have $18 calls listed on the PURR stock. And PURR has been outperforming the underlying because they've been adding excess value. And on top of that, they are incredibly low float relative to the demand that exists. There's still a ton of reasons why people would want to get long that stock instead of an ETF. It is the only place in the world right now that you can buy calls as a proxy on Hyperliquid. There is no other place. It is the only liquid place where you can do that. And so it is my strong view that if you continue to have this entire dynamic where right now we're seeing vol rise or the price rise and implied vol rise at the same time, if that continues and new higher strikes are listed all the way up to 25 and then past that to 30 or 40 or 50, you are going to have everyone really hit the bid aggressively on that, which is going to squeeze positioning and force dealers to hedge their risk and buy more of the underlying. That's why we had so much volume into the close on Friday, because we had the highest call buying volume that we have seen to date in that name. And so and this goes back to the entire thesis that I laid out on Twitter. And again, I covered this more in the report. If you follow capitalflowsresearch.com, you go and you'll be able to get every single thing that I lay out. But the idea here is that this is a chart from Friday, so it hasn't been updated for today. I'll re-update the chart later and I'll share it with you guys. But the key thing is that we are seeing calls go through the roof right now. Total call open interest, which is why the volume spiked so much on Friday. It's one of the reasons. So you're seeing positioning get really aggressively long. And now on top of that, you're on a very low float stock. And you see people beginning to squeeze the float. And we only have strikes up to $18 across all expirations. Vol is rising at the same time. Now add on top of all of this that you're having the Russell add Hyperliquid to the index right here, which now you're adding passive flows to the entire dynamic. And you have an entire situation where it's very probable that you have a GameStop type squeeze where you have the entire move in Hyperliquid run in lockstep with the thesis that was very similar for GameStop. And so here's just a basic chart of how I view that right now. If PURR followed the same GameStop path, right? Because Hyperliquid, sure, it can squeeze up, and if it has this regulatory acceptance, this will fuel PURR even more. But PURR has the probability of having a massive gamma squeeze because it has the options market on it, whereas Hyperliquid doesn't. Now, people are going to come in and try to arb that. I actually think some arbs are going to get blown out because we're going to widen so much. But my view is that you are going to have call skews just blow out. PURR is going to follow a very similar path to GameStop. And you're going to have a lot of traders come in and have to hedge their risk who sold calls. And all of this is going to take place on top of the entire thesis that I've been laying out for where we're at in the credit cycle. So this goes to where we're at with all of these layers. And this is stacking the pages of the book for the thesis that we have. We already have the macro environment pushing capital out the risk curve. Then add on top of that, everyone wants to bet on that, to change that, to have a better access to leverage, to be able to trade all of the US financial products in a permissionless way with low cost leverage. and you have perpetuals disrupting the entire financial system. By the way, people are like, oh, are Poly Market or Kalshi or things like that going to disrupt this? My view is that it is so unlikely. Those guys don't have the reps in the seat to launch a product and to get the liquidity that people will want to onto the perpetual platform. And even if liquidity does show up, I guarantee you that it will be at a higher cost than Hyperliquid, and the commissions will be higher than Hyperliquid, because the only way liquidity is going to show up in those books is if you have traders arbing those perpetuals against the Hyperliquid perpetuals, which means if you're going to arb that as a market maker and provide that, you're now adding on top of that an additional spread, which is going to disincentivize people from using those perpetuals. So again, Hyperliquid has been launching perpetuals and providing liquidity because of the quality of product that it has. You can even look at the CME. When they launch products, they don't always do that well. Liquidity doesn't just appear out of nowhere. And so again, those guys, Poly Market or Kalshi or the Coinbase or whatever, these other platforms, they're not going to talk about that. They're just going to encourage you to trade. And when you open the order book there, you're going to see a very thin order book. And that's the exact reason that no one is going to want to trade perpetuals on those platforms. And so again, all of these things are stacking up over and over. And now add on top of that the gamma squeeze potential for the PURR stock, which is the largest hyperliquid treasury company. All of these factors are stacking to create extreme asymmetry. If only one of them plays out, PURR has further upside. If all of them play out, then PURR has massive upside. And that's really what has happened in a way that I didn't originally anticipate, because the upside is that PURR really moves in lockstep with a bit of a premium, and we've been seeing that. If you just look at the chart of PURR and Hyperliquid, and you look at the percentage change that's taken place right here, you can see that PURR has outperformed Hyperliquid. I mean, it's very clear, very clear. And PURR has now outperformed MicroStrategy. It has a higher P&L. Right now, we're having this entire shift where Bitcoin's selling off a little bit. MicroStrategy is losing a little confidence in the market. You're having a little bit more of a shift. And you're seeing people recognize that the best play right now is PURR. And so all of those factors are stacking on top of each other to create this squeeze. And we have PURR now outperforming Hype, outperforming the S&P 500, outperforming Bitcoin. And it is a representation of the differentiation that it's providing. It is providing returns that are uncorrelated to these other assets in financial markets. And my view is that we're going to continue to see that over and over and over. And now we have just stacked this extreme case where, I think that in the next 60 days, especially because we have this addition of PURR to the Russell on, I think it's June 26th. Because of that, now we're having an additional buying, a factor for buying. And none of this is even taken into account that Hyperliquid hasn't even been added to the United States yet. So if that happens, now you're stacking everything on top of that. Let's say Hyperliquid gets added to the United States. If that happens within the next 30 days and it overlaps with PURR getting added to the Russell, and then you stack on top of that a gamma squeeze and more money flowing into financial markets, people can't even comprehend how high PURR can go. And the point is that we're already seeing all of the factors stack on top of each other to indicate the increasing probability of this reality. So the entire thesis for this is laid out on the Substack, Capital Flows Research, in the PURR gamma squeeze. PURR continues to be my largest position. And you can go through all the research that I laid out here. I'm going to continue to lay out an additional report tonight for paid subscribers that breaks down some of the important signals I'm watching for some of these option flows. But the idea that you want to take away is that there is a stacking asymmetry over and over that the market still does not appreciate. And the outcomes are just stacking to be more and more extreme. So that's the thesis that we have right now. And I want to go through some questions from people and break down some of these ideas a little bit more with James so that you guys can have a clear view of the thesis and be prepared to understand the changes as they begin to unfold.
Let me add one thing to this that can kind of is a little bit of a curveball, I guess, on the thesis. That leans to me towards the bullish side is that nobody just coming into PURR that hasn't been paying attention to this really understands who's behind PURR and how they're executing on the back end. So do you think maybe you could explain a little bit about Bob Diamond and Shemus and how they've executed in the past few weeks and how that they have this credit facility they could use, they have this ability to issue shares and then buy back hype, and they've been doing it super effectively. And if that narrative also spins up, it's the opposite of a lot of what crypto people know, which is where every time there's a pump or whatever, the VCs, the unlocks, the whatever, it just slams it down. It's everything is like an extractive thing. But everything that they've done so far has been what seems to be accretive and positive for the shareholders. Can you explain how that might impact the run up to the upside as well?
Yeah, so the CEO, David, and then Bob Diamond, who is the former Barclays CEO, they are individuals who have a lot of experience in financial markets running banks and asset management firms. So they understand a lot that most people running DATs right now, well, basically everyone running a DAT right now, has no clue about. I mean, the fact that you get PURR added to the Russell, the fact that you get this $1 billion credit facility right away, the fact that you have all these things happening so fast is indicative of the skill that they have. Now, add on top of that they have not taken out any debt. They have shown that they add significant shareholder value by not only issuing shares when we're at a premium, but also buying them back at a discount. No DAT is doing that. In general, I think a lot of the DATs are, run by people who are clout chasing a little bit more than they are adding value. And you need to provide returns not only above the risk-free rate, but also above the benchmark, which is whatever coin you're holding. And last week and the week before, the PURR Treasury Company, they added more cash to their balance sheet and also hype tokens through actively trading basically their stock and buying more underlying than any other DAT has to date. They basically added cash and added tokens at the same time without diluting shareholders, which basically means that they added shareholder optionality and shareholder value, and they did that all just because of the skill and execution that they have. Most DATs, think about this, most people that are creating DATs, they are not traders in markets. They're not market practitioners. They're not risk takers, right? They're people who have probably a really big following, and they've integrated some great marketing. They've integrated some maybe basic debt instruments, but they don't try to take directional views or extract the premiums or discounts in the underlying holdings. But they're trying to pitch themselves as an alternative to the underlying. And so what I would say is that the Hyperliquid Strategies as a company has been showing itself to provide excess returns above the hype token, which is why myself included and a lot of other people want to hold PURR over Hyperliquid ETFs right now. And that hasn't changed. I've been laying out my entire thesis for that for this entire period of time. So we have the fact that they have a $1 billion credit facility where they could, and I guarantee you this is, well, I don't want to guarantee anyone, but I guarantee we're going to shift market expectations around this, because what do you think is going to happen when they use that $1 billion credit facility to buy back some of their stock and also Hyperliquid tokens so that they increase shareholder value and they increase exposure at the same time? No treasury has done that. No treasury buys back its own stock when it's at a discount. They don't do that, right? Because they're trying to run their own strategy on just accumulating more tokens, even if it's at the expense of shareholders. So PURR has done an exceptional job at that, and I think they're going to continue to do that. I think that they have a very high bar set for them, but they have the leadership capability to execute and fulfill in the vision for the high bar that has been set for them in markets. So I think there's just still so much positive things that can happen and optionality in the credit cycle, in the fundamentals of hyperliquid, in the fundamentals of PURR, and in the positioning across every single level as well. So it basically, this is the exact type of thesis that I would want to see to say, oh, this is a stock that I want to be long, because every single level of the thesis is providing extreme asymmetry for the view to take place.
And again, if you are just here for the first time, I want to reiterate, and we talk about this all the time, as cool of a thesis as any thesis could be, you have to sit back first, take a second and think, okay, if I want to act on this, what is my time horizon? What do I expect out of this? What is my risk tolerance? How much of the responsibility of this trade or idea am I outsourcing to this random stream that I'm watching right now? And how much am I willing to accept myself? So before you act, start to internalize all of this. Then if you come to a decision, cool. But we're just here to provide an idea. It's up to you ultimately to figure out how that fits into your specific portfolio, right? This thing has been underway for months. So this isn't some new idea, right? There's been a lot of movement. So you got to figure out, where am I along this arc and this narrative, and how does that fit in for my personal situation? But anyways, just wanted to add that. And I know you have a hard stop today, so let's burn through some of these questions and then we'll get out of here. You want me to throw some up there off the side questions?
I'll jam through them. I sold some calls against 25% of my PURR spot position. I'm actually worried I may get assigned. Basically, the idea here is that you can sell calls against your position, but again, if you sell a call, that gives someone the right to buy your position from you. So yeah, you have to manage your risk accordingly. That's all that's all that is. I would be careful selling calls if we're going to go in the money, then you should expect your stock to get called away. That's what I would say about that. Do you think this melt up lasts for years? Let's just say broadly, maybe. I don't think so. I think that we have this kind of time horizon into the end of the year and maybe beginning of next year. Do I think it's going to last for 5 years or something like that? No, probably not. But we don't know right now. What we're seeing right now is that there's a sustainability and strength, but there's risks building under the surface. All right, I learned my lesson on that. I'm buying tech right now as we speak. Buying all-time highs is generally followed by more all-time highs. Yeah, I think that here's the thing. When I look at PURR right now, I have no issue to say, oh, I think this is going to go up to, $20. I have no issue buying this right here at highs. I just need to size it and have an expectation about my risk that is in accordance with that. So, like if you're going to have this mindset of like, I don't like to buy things at highs, you're probably never going to have any great trades in your life. Just period. Like sometimes you get to buy dislocations, but by definition, dislocations don't happen as much for like these it's just very rare. And so you have to really be able to buy momentum. And that's why trend followers a lot of times do so well. And that's what you want. If you would hold a position, you should also probably be willing to buy it in a sense and have that kind of view online. But my view is that I already have a very large position in PURR that I have at a low cost basis. But if I was just coming to the thesis right now and seeing every single thing that's stacking up, I would still be buying. That's my view. And again, that's based on my personal situation. Loaded on PURR options this morning like a madman. Had a few from the past couple of weeks that have been printing like crazy, but went 10x deeper this morning. I think it'll be very interesting to see how all this plays out. I think that we have a lot of potential for gamma squeezes that are going to really take over this week, in my view, especially as we move into this edition this month of PURR to the index. Yes, I think Yahoo Finance and then StockTwits shared the research that I had. If you guys share this research with anyone, I really appreciate it. I think that we're just going to keep bringing bangers to the live streams that we do every day, and I'm going to keep bringing bangers to the Substack. So go to the Substack, be on there, make sure you're getting everything on there. Guys, important question for me right now is how can I express the bet long PURR using calls in the most efficient way? I'm not going to talk about specific strikes or anything like that. What I will say is that it's hard to, we only have expirations going out to 2026 right now. If we would have expirations going out to the end of 2027, I'd be more comfortable, using those to express long-term views, but we don't. And the strikes are still limited. And part of the reason is because people are kind of afraid because this could get really unhinged. So I'm not going to provide an idea about like the best expression because I don't want to talk about specific strikes, but it really comes down to, how can you be broadly correct and not try to concentrate every single thing. So maybe there is some, if you have a lack of knowledge there, how can you kind of diversify and, some of the maybe lack of experience that you have and say, well, what's a good combination that I could do of a couple different things? I think that's how I would really approach that. How do you know when liquidity is contracting? I'll publish research on the Substack when it happens. Go through the credit cycle reports that I linked in the website. Again, go to the PURR Gamma Squeeze right here, scroll down, go to the credit cycle playbooks. You can see all the drivers I laid out. There is no single factor for when liquidity contracts or single thing. It's a lot of different things that combine at the same time. And that's why I publish research, because it's impossible to have a kind of a single liquidity kind of thing that just tells you, that's like the magic wand, the holy grail. Just doesn't really exist. Why wouldn't people rotate and buy into Hype D instead of buying calls and payment premium for PURR? Very simple. Hype D had utility prior to the Sonnet PURR merger that took place because it was the treasury company that actually had Hype on its balance sheet, whereas Sonnet, previously PURR was Sonnet. You went through a merger and all this other stuff. It technically didn't have it on its balance sheet. And so there was a risk that the merger didn't go through, which is why I traded both last year and not just one. But my view is that PURR is a much superior instrument, not only in terms of fundamentals, leadership, execution, consistency, and the options around it. But you want to bet on winners, not, this just goes back to, can you buy something that's kind of undervalued and make some money? Sure. But, it just goes back to kind of this, the Buffett and Munger thing. Buffett was always trying to buy things at a discount and hold them and then sell them. Whereas Munger just said, let's just get a good deal on bangers we can hold for years and years. And that's really what this comes down to. And so my view is on PURR, and that's the main focus that I have. When do new strikes and tenders get added, you think? I think in the next 2 to maybe 3 weeks. It's unclear, but I think that all of this comes together and plays out within the next 60 days, which is what I laid out in the report right here. I think that in the next 60 days that all of this will, come to fruition, especially the, risk reward that I laid out for PURR. Again, go through all of this. You need to go through all of this. I think that this squeeze will happen within the next 60 days. And that is just looking at what the catalysts are and what it would take for those catalysts to take place and to realize the changes in price action as well. That's what I would say about that. Any other kind of questions you can think about, James, that you would be good to cover here and you feel like would be helpful to kind of talk about? I'd love for you to kind of talk about the entire idea of, we have all these technical factors. How do we pull that together to the mindset around execution, and people weight that a little bit more importantly? Because I think a lot of people on here will see stuff and just say, oh, thesis. Okay, I'm going to win no matter what, right? They think that they have the reps to competently execute and make generational wealth in a single trade, right? How would you begin to frame and approach that conversation with someone else?
You're saying they don't? It's unbelievable. It's super easy. I thought you could just read a tweet that had a lot of engagement, and that was that. And I think we touched on this a little bit before, but I really like to try and figure out where I am on the narrative arc and to be like, where am I in the understanding of all this, the positioning of all this? Where did I come into the baseball game? First inning, fifth inning, ninth inning. And then I like to think to myself, like, okay, is this thesis? Because a lot of people are going to come into this thesis, right? They're going to hear gamma squeeze, they're going to hear GameStop, and instantly your mind is fixed on the tail event. Now, I think we are discussing the idea that the tail has grown and the potential is there, but that by no means needs to mean that it's going to happen, right? So, yes, I think you should plan for that working out. And yes, I think you should think through how you're going to feel and act as if it is working out. But let's just say it doesn't. What is the more base case bell curve idea of how you're going to think about this trade, execute on it, fit it into your profile, things like that? Are you a hyperliquid user? Do you really understand the ecosystem? Do you understand why this even makes sense? If not, maybe you want to get a little exposure and go start learning about the hyperliquid ecosystem. Learn about HIP3, HIP4, the housing of all of finance. Go learn who Jeff Yan is. Go learn about the buyback mechanism. Go learn about the fees that nobody are talking about, right? The vaults. It's just like there's a lot going on here, and I don't think you could whittle it down to like, oh my God, the strikes are small and they're going to just squeeze into oblivion and I should get rich, right? Then go learn about options pricing and volatility expansion and contraction and figure out, am I being the guy that is buying at the worst times? And this is where like the thing you said about reps comes into play, right? Because I have fallen prey to this many a time, into which, I come up with this story, but when I look back in reality, I was like, ooh, like I came into that story late. I'm really good at creating stories. And I convinced myself of an outcome that was a tail event, and I did it at the wrong time. So I'm not saying don't get exposure, but I'm saying figure out what type of exposure makes sense, where you can maybe build on that exposure, how you want to be exposed. Do you want call options? I mean, they only go out to the end of 2026, right? So if you play that wrong and you buy it at the wrong times, it doesn't leave you that much time. So maybe that means you want spot exposure, or you want to play perps exposure on this, or ETFs or whatever. It doesn't have to be a certain way. But that's how I think through this whole situation. I'm just trying to buffer expectations for people when it comes to reading these words gamma squeeze, right? And I think it's really cool to think on, and it is very possible to occur. And we hope it does, right? But like, let's be honest here, if you're trying to sustain your life throughout the world of finance, I said to you yesterday, I was like, in 3 years, we won't be talking about PURR, most likely. Most likely.
Yeah.
Maybe. If we're still talking about PURR in 3 years, like, I don't know what's happening, but it's probably working out, right? But this is all building reps and reps and reps. Like, I think about my 2018 experience, my 2020 experience, my living through 2022, 2023 bear experience. Like, it all builds and compounds on each other to where when something like this comes up, I could be like, all right, James, slow your roll. Let's figure out how this fits into everything. You've never really felt like, looking back, like rushing into something ended up being the best idea. So I'm going to sleep on it for a night. I'm going to read more about it. I'm going to learn more. I'm going to talk to somebody like Global Flows or some other people in the Discords that I'm in or whatever, and then approach it a little bit more sober. Right. So I know things are exciting right now, and I know everybody is looking for the next big play. Me and you have both been getting texts, right? Texts from people we haven't heard of in a while. Hey, what's the next AI move? What's the next whatever. And those are just little hints at like the environment that we're in right now. So it's just warning size, just things to think through, mindset. We touch on this stuff all the time anyway, but yeah.
Yeah, I agree. I think environments like this really test you. I mean, this goes back to, everyone likes to talk about how bear markets test you. Oh, the volatility. You kids won't get it until you've really been through 5 bear markets. It's just like, it's just this very narrow view of how reps are built in life. And being able to make money in a credit cycle melt up tests you in a different way, but it also puts a lot of pressure on you, and it kind of in the same way trading through a bear market does, right? And I think that this entire movement and moment in time is when you are able to put on risk, hold your risk. And I think most people don't deal with success a lot, and so as a result, when a period of time comes where the market rewards a ton of success, then people just aren't really ready for that. And I just think that's one of the most critical factors, because by default, people usually self-sabotage, right? They'll convince themselves to do something, right? They would rather, go all in and fail, or, all in and, go for broke or something like that, than say, how can I consistently make money over time and establish the reps that allow me to take these big bets that actually allow me to realize their full potential and still manage my risk. So I think that all of all of those reps that you have on all these things all converge into moments like we're in right now. And my view continues to be that all these factors are aligning. I believe that we're going to have a gamma squeeze in PURR either way. We're already seeing a little bit of it. We're going to have a gamma squeeze either way. The question is, how much is that going to be? And we have the tail scenario established. You have all the research laid out. The entire slide deck that I went through right here on the section today. This will all be laid out at capitalflowsresearch.com. If you have any questions, you can always go on there and you can go through the most recent article. And every single thing for you is set up for success. You have all of the information, all of the different things that exist on the main page right here. You have all the educational primers that you can go through. So every single thing exists for you to iteratively take all of those reps. The question is, are you going to spend the time investing in doing that? It's all free, right? Like, all these educational primers are free. I have all the paid research that really goes into depth and pulls together things for paid subscribers. But at the end of the day, if you're not someone who understands the investment you have to make, it doesn't really matter how much alpha we share on streams or I share in paid research. It doesn't matter. You're going to figure out a way to screw it up. And so I would just encourage people, go through all of the free material first, and then after that, begin to invest in the paid research and dig into that a little bit more. And that's what's going to prepare you for moments like this. So that's what I would encourage everyone to do. Everything is laid out on the website, capitalflowsresearch.com. And then this would be a great time, especially tonight. James has a bunch of stuff on his YouTube channel on how you think through the mindset of all these factors. If you feel like you understand the thesis, but you feel a little nervous, it's the signal to you that you should probably go and watch a couple of videos that James has put out on these mindset changes that you're going through right now. So that's what I would encourage you to do. James, final thoughts?
The final thought is, like, what's worse than going through a bear market is going through one of these types of times and then losing a ton off the backside of it, right? Because in a bear market, it's almost like you feel like everybody's going through something together and it doesn't feel as bad, right? But when you go on a run and you don't capitalize and you don't actually think about exiting and understanding the maybe shift towards the back end of it, and then you give back not only everything you made, but then go into a bear market, that will be what keeps you from ever coming back to markets. It's one thing to live through a bear market with everybody and then things come back and you get excited again, but it's another thing to have a run and then to give it all away after so much time, and then to suppress it even further through a bear market. So you have to be offensive while also thinking through all of the defensive tactics you ought to be employing too.
Absolutely. Cool. Well, everyone, we'll be doing another live stream tomorrow morning, 8:30 a.m. Mountain Standard Time. We're doing these every single day. We're going to continue to lay out the thesis, the breakdown of what is taking place, why it's taking place, how you should think about it. And I'll be laying out more research on the Substack tonight for paid subscribers. If you guys aren't already a subscriber on the website, go to capitalflowsresearch.com. And with that, we will catch you guys tomorrow.